Hi students, good evening again. Today we are discussing some of the basic concepts in the cost. The first concept that we have is the concept of the fixed cost, and then we will discuss the variable cost, because these concepts of the fixed cost and the variable cost, these are very important while we are discussing the different advanced topics like a break-even point or the CVP analysis or the decision making in the cost and management accounting. So these are very important concepts. We just start with a very basic thing. Let's say that the business has to pay a rent. Let's say this rent is for the factory. Okay. And obviously they have a factory, they are running the factory on the electricity, on the power, so they have to pay the electricity bill also, and this electricity bill is also for the factory. So because we are talking about the manufacturing concerns, so we will discuss the same example. Let's see that this is like a $2,000 per month, and this is like, for example, $3 per unit consumed. Now if we see here, they have to pay a rent. The rent of the factory, how much they have to pay? That is $2,000 they have to pay, and every month they have to pay. It means that is based on the period. That is not based on the production, that is not based on the number of units they are consumed or number of the workers there. So it is simply depending on what? On the period. So they have to pay this $2,000 every month. They have agreed with the landlord. So this is the amount which they have to pay. There's a more production, there's a less production, there is no production even, but still they have to pay this rent. So that is basically called as what? As the fixed cost or the fixed expenses. Now the next expense that we have, or the cost that we have, is what? Is the cost of the electricity bill. And this is what? This is $3 per unit consumed. So they will consume more units, they have to pay more. If they will consume less units, they have to pay less. And if they don't consume anything, so obviously they don't have to pay anything. Let's say in the specific month they have produced 0 units. Here they have produced 150 units. So these are the units they have consumed, and this is the cost which they have to pay. Let's say after that they have like 1,000 units, like 3,000 units. So these are the different units which they are consuming. For example, the factory is on the annual shutdown, so there is no production. Obviously there will be no units consumed for the electricity. So it means the cost which they have to pay is the $0. But the next month they have started the factory, they have started the production, they have consumed 150 units of the electricity. So they have to pay how much? Like a 450 here, 3,000 here, 9,000. If you see here, and if it is like a 3,001, they have to pay 9,003. So every month, or with the level of the activity, what is happening, they have to pay more cost. So this cost is changing. This cost is changing with what? With the passage of the time, the cost is changing, because it is with respect to the activity or with respect to the consumption. It is not depending on the period, either it is for the month of June or the July or anyone. It is depending on what? That how many units they are consuming, how many units, or the production is going on, more production, less production. It is changing with respect to that. But here, even the 0 units, they have to pay a factory rent of how much? That is $2,000. This is again $2,000. This is again $2,000. $2,000 means irrespective, either the production is increasing or decreasing, they have to pay this $2,000 amount. So that's why this is the fixed, and this is called a periodical cost. It is not changing with the level of the activity, so that is the fixed cost. But if the cost is changing with the level of the activity, so then it will be called as what? As the variable cost. Okay, we have so many expenses of the fixed cost, or so many examples of the variable cost also. Let's say like a water bill is there, food bill is there, we have a telephone bill is there. Okay, then for example there's a raw material bill is there. So all these costs are what? These are the variable costs. But if there is a depreciation, insurance is there, or maybe like a salary is there. So these are the costs, like a depreciation, insurance, salary. These are not changing with the level of the activity. You have the depreciation cost, consumed more or less, produced more or less, no production, still the depreciation cost will be there. Same is for the insurance, same is for the salary. You have to pay the production manager, or you have to pay to the admin manager the salary irrespective of the production. So this is what, this is the fixed cost and this is the variable cost. Then one more concept is there, that is the semi-variable cost. Semi-variable cost is what, which is a fixed cost and also the variable cost. Means some of the cost is fixed and then some portion is also the variable, which is changing per unit or with respect to the consumption. We just take an example that they have to pay, let's say, $500 per month, like a bill of some, like we say, internet bill. Okay, and they can use from 0 to 500 gigabytes internet. So the internet they are using up to 0 to 500 gigabyte, they have to pay how much? They have to pay $500. And above 500 gigabytes they have to pay, let's say, $1 per, or let's say $2 per gigabyte. So it means up to 500 gigabytes they have to pay the same $500. So there will be no changing in that. But if they will consume more than 500 gigabytes, what will happen? The cost or the bill will increase. Let's say, for example, in 1 month they have used 400 gigabytes. Next month 505, then 100. So in this month, how much they have to pay? They have to pay only $500. In this month, how much they have to pay? They have to pay $500 plus they have to pay $10, so it will be 510. And again here it will be $500 because it is less than 500 gigabyte. So it means it is the combination of the fixed cost and the variable cost. Means some of the cost you have to pay fixed or month, and then you have to pay, if your activity is going beyond some level, you have to pay something extra. So that is called as the semi-variable cost. So these are the basic concepts: the fixed cost, the variable cost, and the semi-variable cost. And if you have still doubt, if you have any question, you can ask me in the comment section. Thank you very much.